Hey guys, and welcome back to the show where we talk about everything stock related. So we talk about what is happening in the markets in real time and also look at different trading strategies and how it can benefit you in terms of getting to your goals and objectives in the markets. So today we're actually going to be looking at cash and cash equivalent and operating activities. So we're going to look at what they are and how they affect the stock markets. So when you talk about cash, you really are talking about money. And cash is actually a short-term asset. So if you want to get more technical with it, then cash can be both cash in hand and cash at the bank. So what this means is that for companies, they have expenses that would come up at different times, different periods of time, and so they would need to pull on these cash from time to time. So they can either use the cash in their hand or actual cash in their bank account. So cash in a bank account now, it's really just the money that is stored in that bank account. So it can actually be used to make purchases. You can do wire transfers through the cash in the bank, cash at the bank, and you can also wire funds through different purposes, whether it's for investment, whether it's to pay producers or your sellers, your distributors, those sorts of stuff. Now, purpose of actually having cash is that it is needed in a business. Just like when you are living your day-to-day lives and you have money in your hand and you have money in your bank account and you use it to support your daily night lives and your daily needs and your daily living, so too does these companies actually use the money that they have both at the location and in their bank account to actually provide for the needs of the company and to ensure that they are liquid. So I'll look at cash equivalent now. Cash equivalent really is just short-term asset. So it's short-term investments. So short cash equivalents are your money market funds, your money market investments, your certificates of deposits, your commercial papers, that sorts of stuff. So cash equivalent really is any asset that can easily be converted into cash. And when you look at the assets which I had outlined just a while ago, they can really have a maturity date 30 days, 60 days, 90 days, 180 days. So it's really within a year that they mature. And the whole purpose of cash equivalent is instead of having the monies idle in the bank account or at the operations, what the companies would do is that they take a portion, they invest it in some short-term money market instruments, and then they'll actually benefit from interest rates on it. So whereas if they were to have these funds in the bank account, they probably would be earning less than 1 or 2% on it. Now if they have these cash equivalents, they can be earning anywhere from about 2 to 3% upwards on this investment. So if they have, let's say, $1 million that they don't have any real need or use for right now, they can put it on a 30-day money market instrument. They can put it on a repo, and if that repo is say generating 4.5% and they put it on for 30 days or 90 days, for example, then that would actually be much better in terms of usage for that $1 million rather than just having it sit in the bank account getting less than 2% on it. Now, what's the purpose of cash and cash equivalent? The purpose of it is really to manage your liabilities. So as we spoke about earlier, the liquidity. So when you look at your liquid ratio, so if you get more into the fundamental analysis of investing, then you realize that there is the liquidity ratio that is actually pretty key and very important. And so the liquidity ratio comprises of your current ratios and your quick ratios. So the current ratios really are just your current assets over your current liabilities, and what it does, it just tells you how much of your assets can sustain your liability. So a good current ratio to have is 1.5 to 1 or 2 to 1. Now you don't want to go over that 2 to 1 in terms of current ratios, because what that means is that the company would be having a lot more idle cash that they can they could have been using otherwise within the business and improving the efficiency in other areas. So the current ratio really just tells you, for every $1 worth of liability I have, then I have $1.50 or $2 worth of assets to actually cover that. So it really means that it's a cushion that is happening within that actual assets and liabilities. So it tells investors that the company is actually liquid. So if they have some liquidity challenges or so, they won't be illiquid, because they'll be able to actually manage and sustain their short-term liabilities. Now, when you look on the quick ratios now, what it does is that it takes out inventory. So it looks at all the other current assets minus your inventory, and you divide that by your current liabilities. Now, quick ratios don't apply to commercial banks, just simply because commercial banks they provide a service and they don't have any inventory. But if you're looking at a business that offers some sort of product, then that would be the inventory. And so you take that inventory out, and then what that really does is it tells you how much of the assets really are covered by, how much of your liabilities are covered by the assets, and it gives you a more truer picture in terms of the assets and liabilities. Now, a good quick ratio to have is about 1.2 to 1.5. If you have a 1-to-1 current ratio, that is acceptable. And what that really means is that for every $1 worth of liability, you have $1 worth of assets protecting it. And this is simply because you would have taken out the inventory, which means that the inventory would lead to sales, and sales would lead to more cash coming in the business. So if you remove the inventory and you actually have a 1-to-1, then that would mean that that is acceptable. 1-to-2 or 1-to-5 is better, just to have that additional cushion in the event that the liabilities become more, it starts to grow, so that you can actually have that asset just to protect it, and just in the event that something happens, then the company would be cushioning it. So that's it for the actual cash and cash equivalent. So as investors, you want to pay attention to these. And when I personally invest, the first ratios that I always calculate is the current ratios, because if the company has liquidity problems, I'm not going to put my money in it. Simple as that. And so I always calculate my liquidity ratios first, and that's just a tip that you can do when you are investing. Now we're actually going to move on to the operating activities. So operating activities really are just what the business does on a day-to-day basis, and how efficient and effective it is to that business. So when you're looking at your operating activities, you want to look at your advertising, you want to look at your marketing, you want to look at the staff, you want to look at the location, you want to look at just how the staff interacts with the customers. You want to look at all of these things. So it's really just the operations within that company and how it benefits that actual company. Now, when it comes down to operating activities, there are two places that you can actually identify the operating activities. So there's the actual cash flow statement that you can find it on, and that would be the operating cash flows that you look under that section for the operating activities. And you can also find it on the profit and loss statement, which also is known as the income statement. And so profit and loss statements now would tell you the actual expenses of the company. It would look into the revenues that is generated from the company, gross profits, and so it also tells you your operating profit. Now, when persons are assessing companies, operating profits are one of the most important ratios that people look at. It's probably even more important than the net income. Now, while net income is good to look at and to have an good net income figures, means that the company is making profit and doing extremely well. Operating incomes actually looks at the operations itself, and what it does is, even if the company has a small net income or is even making a net loss, depending on the direction that the company is going and the plans that that company has, some investors are willing to actually take on that additional risk and invest based solely on the operating income and the operating profits, and forego that actual net income, net profit, or net loss that the company might be experiencing. So investors who invest solely on the operating profits, regardless of what the net income and the net profit is saying, are investors who have high confidence in the company and what that company is actually going to be doing in the future. And so they take on these additional risks, and with greater risk there is greater rewards and also greater loss of funds. So that's the other side to that statement that nobody really speaks about. They just say greater the risk, the greater the reward. But it also means the greater the loss that you can experience. So when you go back to the operating cash flow now, the operating activities just tells you how much money is generated from the actual day-to-day activities of the business. And so cash flows are usually generated over quarterly and yearly. Those are how they are reported, but companies would be looking at their cash flows on a monthly basis, and some companies would even be looking at it on a weekly basis or bi-weekly basis. So these are like the larger companies and persons who want to get more technical and just to see exactly what is happening on a week by week basis, or if they are just implementing some new strategies, new activities, and they want to have that real time, minute by minute sort of way to phrase it, activities, and just see exactly what is happening. So that is what the operating cash flows does. So when it comes down to operating cash flows, it's really just the activities, the operating activities within the business, and it looks at the income statement and also the cash flow statement, more so the operating cash flow statement. And this tells you the actual operating activities and how profitable it has been, how much cash it has been generating into the business for the period that the cash flow will be looking at. And on the balance, on the income statement, now it would tell you the actual operating profit which some investors would invest and are willing to forego that actual net profit based on the direction that they are seeing the company heading and what the operating activities in that company actually is. So that's all for this episode. Thank you so much for tuning in. If you do like this material and content, I ask you to give us a thumbs up and subscribe so that you do not miss out on any new episodes as soon as they are released. And I ask that you share this show with a friend who you think would benefit from this, and you just tune in again and again. And if you have any questions, leave them down below. Until next time, thank you, take care, love you guys, bye.